We're here to talk about the SCGRAT and the JEST. Now, this was originally done in 2014, and we haven't done it since then based upon popular demand. But the show was called the SCGRAT, the JEST, and the E Street Software. And we did not play the music of Bruce Springsteen. And we're going to have to cut the music of Bruce Springsteen out before we post this on YouTube so we don't get arrested. Anyway, Brandon and I just recorded a 38-minute webinar on the new PPP and ERC rules. And if you want a link to that, just send us an email and just put PPP, and we'll send you a link to that. That will be on YouTube pretty soon. It runs about 39 minutes. We're going to be giving a 90-minute talk on it for Lineberg system on Thursday. We'll know a lot more then than we knew now. So a lot of shameless advertising, but I do want to point out, because I do have a passion for this, I'm going to be at Ave Maria Law School in Naples, Florida on October 8th, 2021 for a 5-hour professional acceleration workshop. So if you're interested in the materials for that, I'll be glad to send them to you. And if you'd like to show up to help mentor some law students or to be mentored by law students, it's quite an interesting interactive workshop program. We go through, and then there is a 7th hour for estate planners, as you see here on page 7. And then we finally have a schedule. Thank you, Jerry Hash, for the Notre Dame estate and tax planning. It's going to be virtual again this year. So we've got the schedule for you here. Please support the Notre Dame Institute. It's a fantastic continuing education event. Brandon and I will be there virtually, and very much looking forward to it. So our series here continues next Saturday at 11 o'clock. Greatest Hits, also known as More of the Same. Then Saturday the 21st, Spousal Limited Access Trusts. For those of you who will still be married by then, please be nice to your spouse. Saturday, August 28th, Family Installment Sale Planning from A to Z. And Saturday, September 4th, Estate Planning, Community Property Trusts, and other topics. So you can go to our YouTube channel and see any of these, but they're more fun in person, or at least for us they are. If you're interested in our software, we have an article about it here, but we're not here today to market the software, although I wish somebody would finally buy it. Okay, I wanted to spend about 10 minutes here on the very basics, because a lot of the comments we get are that the humor's good, but the technical stuff, we lose some people. So let's start with the basics of federal estate tax. And Brandon's not mad at me. He's just going to get some work done while I do the basics, and then he'll come back and save the day, as he always does. But maybe I'll tell you some dark secrets about him while he's gone. Anyway, there is a federal estate tax, and it enables the government to take 40% of assets exceeding $11,700,000. So this exemption, which began long ago at $375,000, was $600,000 when I graduated from law school. And then we just couldn't believe it when it went up to $1 million. And then gradually it made its way up to $5 million. And then after President Trump was elected, it went to 10, and it adjusts each year with inflation, with what we call chained inflation, so a little bit slower than inflation. And it is scheduled to go back to half of what it would otherwise be January 1, 2026, unless Congress and the president act to the contrary. The Bernie Sanders bill, which came out earlier this year to increase my net income, would have it go down to $3.5 million. It is a unified credit because you can use it for gifting while you're living, or you can use whatever's left when you die. So if I gifted $5 million to Brandon today, then my exemption would be 6,700,000 remaining. And then I could die, and anything over 6,700,000 would be subject to federal estate tax. There is an unlimited marital deduction. So even though you may feel that your marriage is limited, the deduction that you would get if you die and your spouse survives you is unlimited. So I could have $1 billion, I could die and leave the $1 billion either directly to my wife, Marcia, who would be very happy to receive it, or if I don't want to leave it directly to her, I can leave it to a Q-tip trust, as you see here on the chart. And the Q-tip trust could have Marcia or somebody I choose or someone she chooses as the trustee. And to qualify for the marital deduction, it would have to pay her all of its income. But it wouldn't have to invest in high income assets. It could just buy growth stocks, which have low dividends. Then, on surviving spouse's death, you add up the assets of the surviving spouse plus the assets of the Q-tip trust, and that total amount becomes subject to federal estate tax. The Q-tip trust has nothing to do with ear cleaning, but it's good to keep your ears clean anyway. The Q-tip trust can also provide what is needed for the health, education, and maintenance of the spouse. Now, on the first death, it is usually best to leave the amount that can pass estate tax-free, which could be as much as $11,700,000 for people dying this year, into what we call a family trust or a bypass trust or a generation skipping trust or a B trust. Lots of names there. That trust could also have the surviving spouse as trustee, as long as the surviving spouse is limited to receiving amounts as reasonably needed for his or her health, education, maintenance, and support. Now, a separate independent trustee could give the spouse as much as that trustee thinks is appropriate. That trust is never going to be subject to estate tax, no matter how much it grows to. And I can tell you in my 37 years of experience that many surviving spouses have found ways to lose everything but that family trust as they get older and people take advantage of them, and or they become very generous, whether they want to be generous or not. It is safest, in my experience, to require the surviving spouse to have a co-trustee that he or she can replace. So in other words, on the death of spouse one, spouse two will be co-trustee of these trusts, with spouse two's choice of trusted CPA, trusted lawyer, if you could ever find a lawyer to trust, or any trust company in the United States. So spouse two could then interview 5 or 6 trust companies, 5 or 6 CPAs, decide what the best fit is, have a co-trustee, pay them, but know that it is going to be harder to manipulate spouse two. So on the left-hand side of this chart, I have the Irrevocable Life Insurance Trust, known to the sophisticated planner as the ILIT. There is a nice loophole for life insurance. If you put your term or impermanent life insurance into an irrevocable trust that we call an ILIT, your spouse could, or your best friend could be the trustee of the trust. The trust owns your life insurance policy, and on your death, that trust continues just like a family bypass or generation skipping trust, but it doesn't use any of your $11,700,000 exemption to get funded. If it is a pre-existing life policy that you own before you put it in the trust, then you have to either sell it to the trust for the value of the policy or live at least 3 years from the time you put it into the trust. So now, if this person has 11.7 million of exemption and 10 million of term life, he dies, and now there's 10 million in a lifetime trust for spouse and descendants, and another 11.7 million in the family trust, and anything above, and those will never be subject to estate tax no matter what they grow to. And if properly arranged, on the second death, they will typically divide into separate trusts for each child, benefit the child for the child's lifetime, and never be subject to estate tax at the child's level, or at the grandchildren level, or at the next level. In most states, you can go 99 years. In Florida, you can go 360 years. In Nevada, 365 years. And in Delaware, 999 years. We recently had a very substantial client change his estate plan to Delaware because he wants this to go for 999 years. Now, the Bernie Sanders plan would tax these trusts every 40 years. And the more recent proposal would tax trusts every 21 years. And I would hope that anything set up before the law changes would be grandfathered. But I will not be here in 40 years to be able to tell you, or at least that has not been scheduled. Now, the surviving spouse has his or her own assets. When the surviving spouse dies, if she doesn't remarry, then we don't know how much will pass to generation skipping trusts for children and how much will have to pass to non-generation skipping trusts. And this is real important. If you're well over 30 million, there's only so much that you'll be able to pass that will not be subject to estate tax at the level of your children. So packing this into trusts early using some of the techniques that we're going to show you can be very important. From a practical standpoint, I strongly encourage you not to leave assets directly to adult children of any ages. There's a lot of reasons for that. One, we see creditors take them away. Two, we see spouses take them away. Three, we see federal estate tax take inheritances away when that child dies. Number four, if the trust says, until my child reaches age 50, get a job. Take no more than $5,000 a month plus what you need to raise your children. Don't ruin your child's life journey. As Robert Heinlein, my favorite author, said, don't ruin your child's life by making it easy. So you have children in their 20s, 30s, even early 40s. You plop 10 million into their checking account. Watch their lives, watch their life journey just become eating potato chips and watching television on jet airplanes. Careers, running businesses, keeping them hungry can be very, very important. The same thing goes for the surviving spouse who remarries somebody who has a lot of influence and who has cuter children than your children. So be careful. So a typical configuration, and everyone should know where they are. Spouse one has a revocable trust. Usually you don't put anything in it. If they're super wealthy, it could sacrifice creditor protection planning. It could hurt estate tax planning to put things in the wrong place. So essential to the plan is properly determining what spouse one or her trust owns, what spouse two or her trust owns, what's owned jointly, what goes into an irrevocable trust for children. Everybody has a $15,000 per year per person gifting exclusion allowance. My exemption of 11.7 million is not reduced. If I have 10 grandchildren, I could give each of them $15,000. that doesn't reduce my exemption. It's $150,000 out of my estate, and I could use a trust called a Crummy trust, named after a taxpayer named Crummy, who put assets into the trust and said each of my children will have 60 days to withdraw up to $3,000 of what I've put into the trust. And if they don't, it'll stay in the trust. And that was intended to qualify the contribution for the annual gift tax allowance. And the IRS didn't like it, but the tax court did like it. And Mr. Crummy won that tax court case, and the IRS acquiesced to that and said, okay, we agree. If spouse one and spouse two have 3 children, then at $30,000 per child, because there's 2 spouses, that's $90,000 a year, can be contributed to this irrevocable trust. And we will give the children notice of the trust and notice of the transfer. And we will also tell them that if they withdraw from the trust during that 60-day period, we will break their arm and disinherit them. But they do have the legal right to take the money out or the asset out. They don't take it out, being obedient, and then it sits there, and that trust could benefit not only them, but other people. Then you have the lifetime bypass trust, which is now known to most planners as a SLAT, a spousal limited access trust. So the story here is that spouse one could give $1 million, which used to be a lot of money for those of you who are interested in history, gives $1 million to an irrevocable trust. Spouse two, in my example, is the trustee of the trust and can receive whatever spouse two needs for health, education, maintenance, and support. Those are magic words in our profession. The second oldest profession I'll mention. And even though the spouse two has the trustee, has the right to receive amounts as needed for health, education, and maintenance, and can direct where the trust assets go when she dies, this trust is not subject to estate tax in spouse two's estate. If it doubles in value every 10 years, which is what happens at a 7.2% rate of return, then it'll be worth $2 million in 10 years, $4 million in 20 years, and $8 million in 30 years. So that's going to escape estate tax. And what's neat about both of these trusts, besides the fact that I get to draft them, is that they are disregarded for federal income tax purposes. What does that mean? That means that even though I have assets in these trusts that are earning income, that income is reported on my personal Form 1040 income tax return. Why is that good? Because I can pay the tax on behalf of these trusts, and my payment of that tax is not considered to be a gift for gift tax purposes. So if I have a client that has $100,000 a year income from an S corporation, the stock is worth $1 million. I put that stock into the gifting trust, and the client, the trust gets $100,000 a year that it invests, and the client pays tax on $100,000 a year, which could be $40,000, $50,000 a year in taxes. It makes the client's estate smaller and the gifting trust more valuable, or that could be under the SLAT. So that would be a defective trust, because back in the 40s, the trusts were in a larger higher tax bracket than people. So the IRS said that that was defective if you tried to do that. So now we have the defective crummy trust. We charge extra if it's both defective and crummy. There's very little humor in the tax law, so we have to use it whenever possible. So let's shed a tear, not a tear from your eye, but a second tier of entities. And yes, I could give $30,000 to the gift trust for a child. But what about if I put $1.5 million in assets into a limited partnership and I gift a 3% limited partnership interest to the gift trust? What's that worth? And those of you who actually know math are going to say $45,000. 3% of $1.5 million is $45,000, but not in the magical world of taxation, because this is a non-voting limited partnership interest. The owner of this interest has no right to control the company, to get a distribution, or to even attend the annual meeting in Las Vegas. So we value it based upon the advice of a valuation expert at $30,000. We've gotten $45,000 out of our estate, plus the growth thereon, but we've called it $30,000, and that is called discounted gifting. But what I could also do is I could say, hey, you know, I own the 99% limited partner interest. The limited partnership has $1.5 million of assets. Why don't I sell the 99% limited partner interest to that gift trust for a $1 million note? Because my valuation expert may say that a 33% discount applies. So now I've moved $1.5 million of assets indirectly into the gift trust, and I take back only a $1 million note. It could bear interest at 2%. So the FLP in 10 years, $1.5 million grows to $3 million. That's under the gift trust, and I'm only owed $1 million, and I'm paying the income tax on the income of the limited partnership. So significant tax savings happens. And when I sell that 99% interest to the gift trust, there's no income tax because the trust is disregarded for federal income tax purposes. Now, there is also an estate tax charitable deduction. So when I die, I could leave everything over $10.7 million to a charity controlled by my children. Or there's other nice things you can do for charity. Now, if you have an active business or a lot of rental real estate and you're over the $10.7 million, your family may get a 14-year payment plan. Interest only for 4 years, then the rest ratably over 10 years. If it is more than 35% of your estate and it is an active business. So a lot of you out there have a lot of rental property, but you're renting on triple net leases. And as a result of that, you're not getting the 20% Section 199A income tax deduction. And when you die, you can't get the payment plan. Now, IRC Section 6166 is very complicated. There have been some recent proposals to simplify it, but you should probably know about this if you are not going to do enough estate tax planning to avoid estate taxes. How do you spell crummy? With an E. In this 1968 tax court case, a wonderful read. Actually, I don't know that I've ever read it. Do you have to tell the children about the crummy powers? The answer, according to 2 tax court cases, is no. As long as the powers were actually in the document and were legally enforceable at the time, the children don't have to actually know about it, according to 2 tax court cases. So, if you have a large life insurance policy and you'd like to be able to get money out of the ILIT to spend for yourself, because you're selfish or practical or both, you can loan money to the ILIT. And the ILIT doesn't have to pay you any interest. The loan rate can be very low, and your estate gets paid back when you die, and that's called split dollar planning. And there can be abusive split dollar planning as well, such as the Morissette case, where you could have a life insurance trust, buy a $10 million policy on your child for your child's planning, and maybe that has a $2 million cash value. You loan the trust $2 million. You're not going to get repaid except at a low interest rate when your child finally dies. And what is that worth? Well, some conservative advisors say that that $2 million right to be repaid at 2% interest when your child finally dies may only be worth 30% or 40% of what you paid for it. So that could reduce your federal estate tax, but the IRS doesn't like that at all. But it is out there. So Brandon, do you want to join us now and we will talk about what we came here to talk about? There he is. All right, so what I want to make mention here, I'll mention it here. Brandon, do you want to take the viewers through page 60? Just because a lot of clients have this situation, and this is what we're doing most often for clients above 20 million who have concern about federal estate tax.
Yeah, so this is the typical installment sale for a married couple. So what we have here is we have an LLC that's been set up and funded with business interests, maybe marketable securities, some sort of assets that are expected to significantly appreciate. We want to have those under the LLC for a pretty good period of time before we enter into the installment sale. We don't want to put them in there one day, sell the next day, take a discount. The IRS is not going to like that. There's set transaction doctrine issues that can apply there, lack of business purposes as well, that can all undo this plan. So we want this to be old and cold if possible. So we have it bifurcated into voting and non-voting interest. And we sell non-voting interest to a SLAT. That's for a trust for the benefit of the spouse and children. And it has to come from just one of the spouses. So we want the ownership to be split between the two spouses. And so then spouse one would sell, spouse two would sell the non-voting interest to a trust for the benefit of spouse one and descendants, and in return receive a promissory note discounted for the lack of voting control. So if this is a $10 million asset, selling half for $5 million, maybe that's only a $3.5 million note owed back, taken into a discount. Now the other spouse can set up a trust that's just for descendants only. And we want it to be just for descendants only to avoid the reciprocal trust doctrine. So if this trust also benefited the other spouse, then the IRS would look at this as if each spouse set up a trust for each other and essentially was the equivalent of their own trust. And therefore, under state law, creditors could reach into the trust, and that would make the trust subject to estate taxes. So we want to avoid the reciprocal trust doctrine. So we just have this set up for descendants only. Again, selling non-voting interests discounted in exchange for a promissory note owed back to the spouse. Now, to the extent the assets held under this LLC appreciate in value over the interest rate of this note, which can be as low as 2%, I think right now, for up to 30 years, or the life expectancy of the grantor, then the excess growth will pass free of estate taxes and be considered outside of their estate for estate tax purposes whenever they pass away, and their estate is frozen at the value of this promissory note. So it works really well for planning with appreciated assets. Now, one complication, one wrinkle, you'll see over here on the far right, this irrevocable trust. And it owns what we like to call the special voting interest, where this trust and the trustee of this trust is someone not related to the spouses here that are funding the other trust. The reason we do this is under a recent line of cases, PAL being one is the name of the case. The IRS has made the argument that if spouse one and spouse two, through the ownership of voting interest, can control when liquidations or when distributions can occur under this LLC, that's too much control for estate tax purposes, and we're going to include the assets of the LLC in their estate. So if we transfer those voting rights, that's the right to control a liquidation or distribution, to a trust outside of their estate, independent trustee not related to them, then that gets rid of those voting rights and therefore should not cause inclusion of the assets of the LLC in the estate. So this is a wrinkle to put on the installment sale to avoid having too much control under the spouses under the IRS's recent arguments for 2036 A2.
Okay, so we put $15 million worth of investments under the LLC. Spouse 1 and 2 keep the voting control of this LLC. They each sell 49.5% of an LLC worth $15 million for notes of $5 million each. Where do I get $5 million each? Well, 49.5% non-voting of a $15 million entity before discounts would be worth just under $7.5 million. If I take a conservative 33% discount, it's only worth $5 million. So now the LLC has 15 million. The trusts own 99% of it, and they owe 10 million in notes. I've got 5 million out of the estate without any gift. I will make a seed capital gift to each of these trusts in order so that they have an independent net worth. That seed capital gift, in my example, will be about 500,000 per trust. That 500,000 is more than enough to pay many years of interest on the $5 million note at less than 2% interest. So the clients are getting a couple $100,000 a year in interest. Excuse me. Now the LLC doubles in value to 30 million. The notes are still only 5 million. You liquidate the LLC, and the trusts now each have 10 million plus whatever's left of the 500,000 gifts. So you've moved a lot out of the estate, and the parents have paid all the income tax on the income of the LLC. So let's go ahead and skip forward to the SCGRAT. The SCGRAT is a self-canceling installment note that uses a grantor retained annuity trust to avoid the gift tax risk. So what is a self-canceling installment note? In many of our previous Saturday webinars, we've discussed the fact that when I sell assets to a trust, I can take back a note at the long-term applicable federal rate if the note is over 9 years. Typically, the note will be based upon my life expectancy. I'm 62 years old. My life expectancy under the IRS tables is probably about 22 years. That's a lot of billable hours from now. So I could sell 15 million worth of assets indirectly for a $10 million note, bearing interest at about 1.5%. But let's say that when I die, I don't want to have that note. So Brandon goes to Number Cruncher software or Tiger Tables software, and that's why we have a picture of a tiger up there on the top right-hand side, because we like Tiger Tables software. In Tiger Tables software, Brandon, what's your guess? If I did a $10 million note, what interest rate would I need to use so that that note would cancel on death without the receipt of the note being considered to be a gift by me?
Yeah, let me just actually pull up Tiger Tables now and I'll let you know.
Yeah. So it's probably like an 8 or 9% note.
It's probably less than that. I'm going to say around 6%.
Okay. Brandon's all excited that I might die, so he's looking it up. That's a great idea.
Of course not.
Then he can do these Saturday webinars without me. I just get in the way. So what happens sometimes is a client comes to us and says, you know, I have a short life expectancy. All the males in my bloodline die at age in their 60s from heart attacks. Or I just had a diagnosis of a type of cancer that gives me a 5-year life expectancy. Can I go ahead and make this sale of $100 million in assets for a self-canceling installment note, and then I'll spend the annual interest I receive or gift it to charity, whatever I do, If all I own is the note and then I die, then there's no federal estate tax. So it becomes a very good idea to do a self-canceling installment note. You have the number there?
Yeah, and Alan, so you have a 20-year life expectancy, so we can do up to a 19-year note, and the risk premium is just under 4%, 3.977. So add that on to the current AFR rate of around 2%, and we're right about 6 or just under.
Okay, so I only have a 20-year life expectancy, but that's based on tables that include smokers. I hope I go 22, but anyway, going back to this. So now I'm getting a 6% note, but because if I have cancer or some other type of malady, the IRS says that I have made a gift based upon what a willing buyer would pay for that note. So in other words, if you owe me $10 million at 5% interest, what would somebody pay to hold that note, knowing that the note disappears if I die of my disease? So the IRS says that that's a gift. Now, we don't think it is a gift, and here's why. There are regulations that say that if you sell assets in exchange for a private annuity, then you can use IRS assumptions as if you were of normal health, as long as either, one, you live at least 18 months after making the sale, or two, you have better than a 50% chance of living 1 year. So we've done a few of these where the client comes in and says, I have lung cancer, it has spread. My life expectancy is 2 years. Well, we get a letter from the doctor. The chances are much more than 50% this client will be alive within a year. We make the sale, $100 million worth of assets in exchange for a $100 million note. The sale is made to an irrevocable trust, so we don't trigger any income tax. The client dies in year 3. There is no federal estate tax. The family is less sad than they would have been. There's not even an estate tax return to file. We feel that that's okay because a promissory note is almost exactly the same thing as an annuity. It's a right to receive payments over time. Now, the alternative is we structure it as an annuity. And a typical annuity is here's $100 million worth of assets, pay me X dollars a year for the rest of my life. Brandon, if I sold $100 million worth of assets as a 62-year-old, how much a year for the rest of my life would the trust have to pay me?
Yeah, let's see if I can compute that one. So one note on your note, the premium is actually, the total interest rate is just under 4%. The premium is only 1.977%. So
okay,
even better. It's not even a full 6%.
Okay. So anyway, if I do a private annuity, it can work almost exactly the same, but there's something called the probability of exhaustion test, which says that the party or trust who owes me the annuity has to have a huge net worth, a net worth sufficient to make all the payments until I am year, I believe, 100. So you usually can't use the annuity.
$58,000 a year on $1 million asset.
Okay, so for $100 million, it would be $5 million a year, which would build my estate back up higher than the 10 million 7. But if I did it for a $100 million sale for a 4% note, then I'm getting what, 4% a year, or 400,000 a year. I mean, 4 million a year,
4 million,
which I'm sure I could find a way to spend. So how do I do this self-canceling installment note without it being considered to be a gift, which causes me great hardship while I'm alive? Because clients basically say quite often, you know what, I don't care how aggressive we are, try to avoid the estate tax, but if it's going to have repercussions and the IRS is going to come audit it and challenge it, just make sure that's my kid's problem, not my problem. So this is where we came up with the idea of the SCGRAT. So in the SCGRAT, which comes from the writings of Stacy Eastland, by the way, credited here on page 85. With a SCGRAT, what we do is we first put the 10 million worth of assets in this example under an LLC owned by me, and then I take back a $9 million note. The LLC owes me $9 million, and that's a note that is at 4% for 20 years, but cancels while I'm alive. And then I sell the LLC, not to a trust for my children, but to a grantor retained annuity trust. The grantor retained annuity trust says that whatever I give it will be valued, and it will pay me 27% of the day one value in 4 equal payments. And whatever's left in the GRAT belongs to my descendants and is held for the lifetime benefit of my descendants and spouse. It's out of my estate. So I think that this LLC is worth $1 million because it owes me $9 million and it has $10 million of assets. I think it's worth $1 million. So the GRAT owes me $27,000 a year for 4 years. I get over 4 years about $1 million, a little bit more. And then I die. And when I die, the note cancels, the LLC has 10 million. So I've just traded $1 million for 10 million, and there is no estate tax because I got back very little. But, and that's illustrated here. The LLC owes me the note, and the GRAT owes me for the 4 payments. Now, the IRS comes in and says, bull honky, if that's still a word, and says, that GRAT was worth 9 million. Your note was only worth $1 million. You were going to die soon. So the GRAT now owes me 4 payments of $2.4 million under the adjustment clause, but there's no gift tax. If I recover from this terrible thing and I'm going to live my 20 years, and the IRS sees that I did this, they're going to try to get gift tax from the date I set up the arrangement, and they're not going to be able to get gift tax. They're just going to require the GRAT to regorge the difference between $270,000 a year and $2,430,000 a year. So that is the SCGRAT. And we have articles on the SCGRAT that I'll be glad to send you if you send me an email with RE SCGRAT. And thanks to my partner, Christopher Denicolo, for coming up with the name SCGRAT. It's a skin and it's a GRAT. It's a SCGRAT, but it's not a cat. All right, Brandon, anything to add on the SCGRAT?
Yeah, no, I just think it's a good way to use the automatic adjustment language that's contained in a GRAT. We tried to do that with installment sales through use of adjustment clauses, but those are not statutorily approved like the adjustment clause in the GRAT is. So if you have a high risk or hard to value asset, the use of a GRAT can be very beneficial because of that adjustment language that's in the statutory language. So just to keep that in mind for planning purposes. The only downside, you can allocate, or you can, but it's very difficult to allocate GST exemption to make a remainder trust fully exempt in a GRAT. So that's why the installment sale is usually preferred, because that is fully GST exempt, where a GRAT you have to do some little bit more complicated planning to get GST exemption into a GRAT.
Thanks to Abigail for correcting the interest rate. Abigail calculated that the interest rate on a note owed to a 60-year-old that will self-cancel during the 60-year-old's lifetime is 3.977%. So that is a very good Observation, David says the loan interest paid from the trust to the grantor is not taxable to the grantor. That's correct. The transaction is ignored for income tax purposes. Lee says, can the trustee of the trust be a son or a similar family member? Absolutely, it can be. David says, can the note be discounted in the grantor's estate? Yes, let's say you do a note that is not self-canceling, and I die in year 5, and you owe me another 15 years of interest at only 1.5%. Who here would pay me $1 million for a note that only pays you 1.5% interest for 15 years? No one has raised their hand. So a 20% discount, 30% discount is not unheard of, which is why for a lot of clients, we prefer to sell for a note than to make a large exemption gift. Because if you make a large exemption gift, you've used the exemption, but if you get back a note and you die or gift the note, you can take a separate discount. So now let's go to the JEST, the Joint Exempt Step-Up Trust. And there's articles on the JEST that you could Google Gassman, J-E-S-T, and the articles come up, or send us an email. We'll be glad to send them to you. There's an article here that I wrote with Jonathan Blottmacher, who is perhaps the greatest estate planner in the United States, if not the universe. And we wrote it in 2013. I think it's still plenty pertinent. Brandon has drafted a lot of JESTs. So Brandon, do you want to explain why this joint trust that a married couple can put assets into might be better than having separate trusts or a joint and survivor trust?
Yeah, so the real benefit of the JEST and the whole purpose is to try to get a full step up in basis on the first death as well as the second death. When you have assets that are jointly owned or in 2 separate revocable trusts, then you would only get a step up on the first death of half of those assets, and then the second half on the second death. So the idea here was to try to get a full step up on both deaths. So how exactly can we do that? Well, we put assets into the joint trust, and then we give the first dying spouse a power of appointment to appoint the assets to their estate or to the creditors of their estate, which causes the full amount of the assets to be considered as included in the first dying spouse's estate. And therefore, if you have assets that have or they're subject to a power of appointment in your estate, when you die, they get a step up in basis. In the second death, we do the same thing. The surviving spouse has the power of appointment to appoint the assets to their creditors, and therefore would result in a second step up in basis. So there is some complications involved. Whenever I receive an asset and give it right back to someone that just gave it to me within a year after I die, then that doesn't qualify for a step up in basis. So let's say I know Alan's getting ready to die. He's on his deathbed. I have $1 million of Apple stock that I bought for $100,000 10 years ago. So I say, hey, Alan, I'm going to give you this Apple stock. You just give it right back to me in your will when you die. Therefore, I can eliminate that $900,000 of capital gain that I have in that stock. If that comes back to me within a year, I don't get a step up in basis. So the argument here is that when a husband and wife put assets into this joint trust, and husband dies and has the full power appointment over all the assets, that wife is making a gift of her half of the assets to the husband and then getting them right back as a beneficiary of the trust within a year. So how do we avoid that argument? Well, we can set up 2 separate joint subtrusts upon the death of the first dying spouse. So husbands share the assets, who's the first dying spouse, goes into a trust for the benefit of the wife and descendants, your typical credit shelter family trust. But then you also have credit shelter trust B, where if wife's share of the assets are considered as funding the credit shelter trust, then those would go into a second credit shelter trust where the wife is not an automatic beneficiary of the trust. can be added as a beneficiary of the trust potentially, but not a beneficiary of the trust upon inception. And that should avoid that IRS argument of, I believe it's section 1014E, where assets are considered as gifted within 1 year, and therefore no step up would apply. So how does this work when we have a taxable estate? Well, you can still do the same thing with funding of Q-tip trusts. So you would use the full exemption amount to fund the credit shelter trust. Maybe that's all from husband's share, so we don't have a credit shelter trust B. And then whatever's above and beyond the excess would go into the Q-tip trust A, and any of wife's shares would go into Q-tip trust B. So that can work well for estate tax planning, but it's really an income tax planning tool. Some complications involved, but the main idea is use of powers of appointment to allow for a full step up in basis on both the first dying spouse's death and upon the second death as well.
Brandon, let's say that Marcia and I set up a JEST, and the first one of us who dies is going to have a power exercisable in favor of creditors of that spouse's estate, but only with the consent of a couple of friends of ours who are not fiduciaries, so that I don't go crazy and leave it all to somebody who Marcia's never met. Could we also give Marcia's father, who is very near and dear to us, a power, make him a beneficiary of the trust, and give him a power to appoint the trust assets to creditors of his estate with the consent of our friends, so that if he were to die, and we would miss him very much, all of the assets in the JEST would get a step up in income tax basis?
Yeah, that's definitely a good planning idea. I think a lot of people refer to that as upstream power of appointment basis planning. So giving an older generation the power to appoint assets over a trust, causing inclusion in their estate, and then allowing for a step up in basis to occur is definitely a well-known planning technique and can provide great benefits.
So for all of you lawyers on this webinar who are drafting irrevocable trusts and even revocable trusts, is there someone old who is not estate taxable who would like to be the proud owner of this trust on their death for purposes of section 1014 of the Internal Revenue Code, whether they even know it or not? So for example, we recently set up an irrevocable trust for a family. We put $30 million of zero basis real estate in it, and the trust owes the clients $27 million. The trust only has a value of $3 million. Grandma has an estate tax exemption of $5 million. Grandma has the power to direct trust assets to creditors of her estate with the consent of non-adverse people who are not beneficiaries of the trust, who have no fiduciary duty to allow or disallow her to do this. Grandma dies, and $30 million worth of real estate takes a new basis of $30 million. You do a component depreciation study and get a $4 million income tax deduction the first year after Grandma dies. So we'll miss her cheesecakes, but we'll appreciate the $4 million income tax deduction. Now, the alternative to the JEST, which David is pointing out here, David has so many good points that we should let him give the webinar next week, and we'll write questions. But David says, why not a community property trust? And we recently posted a Lineberg newsletter, and also did a webinar on community property trusts. In order to do a community property trust, which should, not definitely will, but should get you a step up of all assets on the first death, number one, you have to have a trustee who's in a state that allows for these. That's Alaska, Tennessee, Florida, and South Dakota. Number two, on the death of one spouse, half of the assets go pursuant to the will or trust instructions of that dying spouse. The other half of the assets are going to the surviving spouse. So you can't lock up all the assets for the health, education, and maintenance of the surviving spouse in a community property trust. Third, if one spouse is sued, half of the assets or all of the assets of the trust are accessible to the creditors, depending upon what state you put the community property trust in. If you put the community property trust in Alaska and one spouse is sued, you lose all the assets of the trust. If you put it in Florida or Tennessee, you lose half of the assets of the trust. Let me also mention, I missed that Kentucky has these community property trusts also. Now, Jonathan believes that the Alaska Community Property Trust, which he carefully drafted the law for, gives you a better chance of a full step up than our JEST trust. And I'm not going to disagree with Jonathan, because if you disagree with Jonathan, something happens in the universe and he turns out to be correct. So I would never disagree with him. Maybe I don't see it that way, but I would never disagree. For you and for the Florida lawyers, there's a really nice thing about the Community Property Trust. It is an anti-elder abuse trust. And I'm going to publish an article in Forbes as soon as I can proofread it about this, because a married couple can form an irrevocable community property trust in Florida without giving notice or accountings to any of the remainder beneficiaries. So if you have a client who you think may be subject to abuse, and the most common form of abuse is one spouse dies, or that both spouses get frail, and the child who is the least trustworthy also has nowhere to live and moves in with them, and then inherits everything. But if the community property trust is irrevocable, then it will be impossible, at least legally, for that child to change where it will go on the second death, and you have a business reason for putting it in there. The child doesn't have to get offended. So that would be one use of that. If you'd like to see our white paper on this, just email community property white paper. So we have more information on the JEST. There are articles by Jonathan Blockmacher and Michael Mulligan about what the IRS may use to challenge the JEST or the exposures, but we think we've designed the JEST with their articles in mind to be a pretty good mousetrap. It's not a match for all clients, but it's a good match for some of them. Finally, if you believe that portability is better, I'll just leave all my assets to my spouse, or to a Q-tip marital deduction trust for my spouse. I won't use any of my 11.7 million exemption. My spouse will have the benefit of my exemption, and there should be no estate tax on the second death anyway. Please run the numbers, because it usually doesn't work out that well. And we do have a mathematical example here. I won't go through it. Brandon, we're just at an hour. Any final questions, comments, or suggestions that you would like to cover?
You know, I think just one good question here is about the SCGRAT and the skins. And the question is, isn't there a risk of outliving the term of the skin period? How does this impact the benefit of the SCGRAT? So that is the risk with the skin, is you are paying a higher rate of interest than you would with a normal installment note. Situations such as Alan, where it's only a small 1.9% premium, then you're losing out on 2% rate of return each year that would otherwise not be included in your estate. But it's still an effective planning tool. If you're getting more than a 4% rate of return on the assets, then the you're passing growth outside of your estate. You're also able to lock in those discounts that you took on the original note sale. So still not a bad deal. It's just not going to be as good as the typical installment sale if you don't outlive, or if you don't die before the end of the note term.
Okay, so to Abigail, Alan, Allison, Amir, Andrew, Anita, and those are just the A's. We want to thank you for joining us today. We welcome your questions, comments, and suggestions. We had 3 interesting questions come in this week by email that we didn't get to today. We will answer questions next Saturday. In fact, next Saturday we'll start off with questions. So please send us your questions and your comments and any criticism. We will always appreciate as we try to make this better and better as we run this for as many Saturdays as people can stay awake for. Also, please come to Naples, Florida, Friday, October 8th for your tax-deductible weekend in Naples to do some breakout sessions with some young lawyers and with some law students to help them understand how you became successful so that they don't have to make all the same mistakes that we've made in our life journey. Help others and have a fantastic rest of your weekend. Thank you very much, Brandon.